should have in your chart, okay? Now, because it's on what time frame, what's up here? What's this? This is a daily chart. You want to be able to add your quadrants, okay? So these are very specific levels. It's not a fucking zone, okay? It's not supply and demand zones where who the hell knows what you're supposed to trade off of, okay? It's very specific levels that we're looking for. So on a 4-hour chart, we drop down. Okay. So the market's drawn back up into this area here, right above this short-term high. This up-close candle, I would not call that an order block. Why? Because it's outside the range of that daily fair value gap that's also incorporating the volume imbalance. So all of this movement back in here, I would discount all that, and I would look at a up-close candle above this area here to be my bearish order block, which would be this one here. Okay, rules, folks, rules. That's what's going to be in the books. Not every up-close candle is a bearish order block. So if we have our lower quadrant level here, does it want to get to that lower quadrant level? Does it do so speedily? And does it close above it when it gets there? If it doesn't, that's suspect. That means it might want to revisit all this down here. And this area here, between this down close and this up close, this little segment of price action right in here is a balanced price range. So it'll take a more meaningful move to get below this. So any retracements could be met with some kind of support in here. If we lose this area here and it comes back up and touches it, that is, in my opinion, potentially very bearish. But I can't stand the Dow. The Dow is very, very fickle. It's spotty. It doesn't want to listen many times what the other ones are doing. But it's usually very helpful when it comes time to looking for intermediate or intraday SMT divergences, where the Dow many times is the one culprit that will say, I'm not listening. I'm not going to make that lower low, or I'm not going to make that higher high, where the NASDAQ and S&P would. That is something that you want to add to your SMT notes, that if you have an SMT divergence that is using the ES as the divergence or the NQ as the divergence, those are going to be your stronger SMT divergences. What'd you just say? I just gave you some gold. True, yes, I'll take an SMT divergence if it's the Dow, if I'm really, really strongly convicted about the idea I think the market's going to go. But I usually demand ES or NASDAQ to be the divergence because it's a larger degree of stocks, because the Dow is only 30. And those companies are, they're not what they used to be, versus 100 of the tech stocks or 500 of the blue chip stocks that are in the S&P Composite Index. So there's a little bit more weight placed on my S&T divergences when I'm using it as a catalyst behind the ES or NQ being the diverging index. So if that index is one of the two, ES or NASDAQ, I'm going to have a lot more faith behind that SMT divergence than it would be if it was just the Dow. So if I'm seeing it on the Dow, I have to have other things really siding with me that it's going to move. Otherwise, the SMT is not going to do it for me. It's not going to be the thing for me to say, yeah, this is a good qualified trade. So just toss that in there at no extra charge. Just make sure that this is down here as your balance price range, okay? And a 60-minute chart. Man, I'm doing a clinic today. Shit, I should have charged money. Could have got myself some cheesecake. All right, so here we have the hourly chart. Now look how this run here. From here, run. Don't worry about the shaded area here because we did that after this forms. But look how it goes down here, runs up, trades above this high there. No inefficiency because it goes immediately down into the order block. But where specifically does it go? What is this? It's a wick, right? Wicks are treated as a gap or inefficiency. So if we treat this range, when I'm watching price move higher or lower, I'm looking at every single wick. Let me get this off here. Don't need the quadrants for this. When price was up here, and if we thought price was going to go higher, go look at all of the times I'm trading. When I'm doing my executions, I'm adding pyramiding. If there's a wick that it's trading back down into, you'll see me entering at it. Look where it goes, right there. And what is that little movement below it? What's that called? A mohawk. It's perfectly permissible. That's exactly what the algorithm's going to want to do to offer what? Smart money that has an algorithm that's going to handshake with it. Okay? Here's the conspiracy that most of you are going to say it doesn't exist. But I'm telling you, when you start looking for it like this, you're going to see it's there all the time. And then you're going to really have a problem sleeping at night because you've been believing in Bollinger fucking Bands. So right in here, we have a consequent encroachment. That price level is 32,806. The low here is 32,801. So we're only talking about what? 5 points? And this is on an hourly chart. An hourly chart, and you're only talking about 5 points deviation below a consequent encroachment level. Are you going to be wrecked if you have to trade with something that allows for a stop loss that's just above 5 points in the Dow? And trusting in a logic that where you're entering there should be some movement that supports your trade and it should run higher? What's this over here? What's this right here? Same thing, right? Same thing this is. So if we look at both of them, what is it doing here? It's overshooting this one, but it has to refer back to this one as well because it's also a wick. So it's a gap. 2 consecutive gaps in the form of a wick. So you have to look at that. That's real fucking order flow. You're not going to see that on a depth of market. You're not going to see that on ladders. You're not going to see it on volume profile. You're not even looking at this stuff. You're not looking at this, but I am, and I'm executing on it. My entries are fucking phenomenal. They're consistent. They keep happening all the time using the same logic. I'm teaching you how I'm doing it. If you're bullish, you're looking at these levels. Even if you have already positioned your entire trade and you're not going to add anything more, you're still going to look at price like this. As it's forming in each new candlestick, does it go down to that level? Okay, it's going past a little bit. Okay, it shouldn't go beyond that. Now it should start to reverse here and create a long wicked, candlestick bottom or low, or what we call it, a tail, I guess. Okay, and then it does this. Wonderful. Then we open here. We trade down. What's it going to? This wick right there. Does it need to go to consequent encroachment below here? It could, but what happens if it doesn't and it turns and starts rallying? What does that indicate? It's really bullish. There's no need to worry about putting a stop loss right below that low now or trail it up to that point. There's a logic behind everything I'm doing. I'm teaching it to you, but it takes time to explain it. You have to see examples of me doing it. What's the logic that I'm using?